In 2018, emerging markets have been falling further and further, their currencies weakening and their stock markets looking unattractive. Meanwhile, the Nasdaq has outperformed other markets as FANG stocks reach higher and higher prices thanks to quantitative easing from central bankers. But can the US markets maintain their dominance in such an interconnected, globalized world? You came here for the truth, so let me unveil that for you. Today, we are going to talk about emerging markets. We're going to talk about China. We'll talk about the US as well. I've got charts and articles to show you in this jam-packed video. So let's get into it right away by looking at the returns year to date. And it should surprise nobody that the Nasdaq is on the top of the list. We are seeing the usual suspects being at the top here. Very clear with the Russell 2000, the S&P 500 just behind that. Now we're looking at the S&P 500 being up 10% this year. That is quite significant. Historically, 10% over a 2-year period might be considered good gains, but right now we're seeing that in not even a full year. So this has been the year to date. By the end of the year, who knows? Will it be up 12%? Will it be up even higher? Or will things change? At the very opposite end of the spectrum, priced in US dollar, we can see that Turkey, South Africa, Brazil, China, emerging markets are all suffering right now to a different degree. Obviously, Turkey is in the worst case on this chart, but I can see that this has been the case with their currencies over the last few months. In fact, we have seen the weakness that has prevailed. Their entire markets surrounding them have all been very, very worrisome. They've been trading as if the world is going to end, all because they're unsure of what will happen in relation to the US dollar. It is not even a concern of the problems in their own country. It's always against the US dollar. That's the way they look at it, because it's the reserve currency, because all of these commodities, everything that they import and export, are priced in US dollar. And if their currency starts to look weak, it starts to become much more expensive to service US dollar denominated debt. And it becomes more expensive to be able to purchase goods when you have to do that in a currency that's much more expensive than your own. So that's the dilemma that they're in today. I'm going to show you some information further about Turkey in a second, but I wanted to show you this. I always cover these whenever I can grab them. This is showing us September 14th to September 17th, what has happened with the currencies of the best spot returns, the worst spot returns, and the usual suspects are here, whether it's Turkey at the bottom of the list here, whether we're looking at the Indian rupee I've shown you here before, the South African rand, the Indonesian rupiah, and others are weakening throughout the last few days, the last few trading sessions. So I just wanted to make sure you're aware of that. I constantly track the progress there. America first, S&P 500 remains strong in 2018 while European and emerging market stocks slump. The black line is the S&P 500. You could see it rocketing higher and higher throughout 2018 after we saw this dip down where all markets around the world seemingly began to fall because of the whole VIX index and everything that followed with that. Then we saw this change that occurred where the S&P 500 rocketed higher. The European markets, in this case, looks like it's down about 2.5%. So it has slumped to some degree, but clearly we have seen emerging markets, the purple line here, have just fallen off a cliff practically, and this seems to be down, I would say, about 11 or 12% according to this chart. So that right there shows us how bad things have become, but it depends on where you look. Do you want to look at Europe? There's a lot of things that are not going right in Europe, I'll tell you that much, and it's not even the structural issues of the EU itself, of the Eurozone, of one interest, of one currency. We have other problems going on today. The sovereign debt crisis, which I like to refer to as the European viral contagion in my books. But this here shows us how bad things have come throughout 2018 alone. All right, now I want to talk about China for a moment. Shares in Hong Kong closed in the red, and China's main Shanghai Composite Index fell to its lowest close in nearly 4 years on Monday, as reports there would be $200 billion worth of tariffs added on top of the pile of tariffs that are already in place. China said it may decline an offer of renewed trade talks with the U.S. if there are more tariffs. We're not going to do business like this. That's basically what they said. All right. Now, they make reference back into 2014 where that weakness had come on, and I want to show you the Shanghai Composite. Now look at this. This point here was the beginning of 2018, and ever since then, the Shanghai Composite has come down. The last time I checked, it was down 25% from its peak. But look back in 2015, where we saw the prices reaching a spectacular high. All right? But it came down from there. If you take it where it's over 5,000 at that point, to the point we're at today, it has dropped 50% from its absolute peak. And that, my friends, is a very, very significant decline. But you can look at it in the current decline on a more short-term time scale throughout 2018, it's down 25%. Does it really matter? We are seeing this being very significant, and even with all of the stimulation that we have been witnessing from the quote-unquote national team, where we have China's subsidiary corporations and entities purchasing stock, and we have witnessed, no doubt, that the stocks that they purchase are the ones that perform better than the general stock market. So obviously they have been working on this, pushing them higher. No, they have not been buying all of the shares. They have not been a significant purchaser to the degree of Japan, for example. But it's still very, very important to look at this and to see it for what it is. I mean, we're going back at the levels we have not seen since 2014. All right. Now, maybe you could say that this peak up here was not justified. It should have never have been there. But we're still down significantly, even after all this slow-paced recovery throughout 2016 and 2017. It was gradually and constantly strengthening through that time period. But ever since, it has come down. So I'm going to track the progress consistently on China, and I will show that to you. Out of Reuters, China stocks dropped to near 4-year low as the new tariffs are coming in, $200 billion worth. The central bank moves to keep the money market rate stable. So there's always a set of intervention actions that are being taken place. I could see that with China, but I also see that with all other stock markets, all other countries, I should say, whether it's Argentina, whether it's the US, they all have something that the US likes to call open market operations, and that is directly influencing what interest rates are and how the market is going to respond to their level of intervention. They know it. They already know ahead of time how it's all going to be. So now moving to Turkey, all right? So looking at this, I think it needs to be said, I'm just going to tell it like it is. The Turkish government will unveil measures to help banks tackle the expected pileup of bad loans resulting from the lira's plunge and soaring interest rates. All right. What are the measures? What do you think? Before we get into it, what are you thinking? Measures, maybe increase interest rates, maybe printing some money. Who knows? Right? It could be anything. The plan will seek to mitigate the need for capital injections and propose carving out non-performing loans for transfer to a state-designated entity. Now, that's a lot of jargon. That's what they do in the financial industry. They like to confuse you. They've confused me, that's for sure. But I'd like to look at it for what it really is. I don't really like to talk BS. I want to call it for exactly, positively, what it is. And I'm just going to say it. It's a bailout. It's a bailout. The taxpayers in Turkey are going to be paying for the non-performing loans, indirectly or directly. This is the same thing they do in all countries. They bail it out in one way or another. They can use the central bank, they can use the taxpayers, they can use the bondholders, but either way, these banks, which constantly take too much risk, they don't have enough reserves, and they simply make mistake after mistake after mistake, and they're unable to weather any storm. And then the government has to come in and backstop the losses. It doesn't matter if the country says Turkey here. Doesn't matter if it says Argentina. Doesn't matter if it says Brazil or Italy or Spain or any other country. They all do essentially the same thing because it is the problem at the root. The roots of the plant are rotten, and you will never get ripe fruit from that tree. It's just the way it is. Shares of Turkish banks rallied on the news. Of course, we're getting a bailout. All of our garbage is going to be transferred to the taxpayers. Hallelujah. Turkish lenders have been struggling to deal with the pileup of restructurings. I love that word. That's a scary word. Saw that in Greece. After the lira dropped about 40% against the dollar this year, matching the Argentine peso as the world's worst performing currency and hurting firms' ability to repay foreign currency loans, the energy industry alone owes $51 billion US to the nation's banks. And that becomes a bigger and bigger and bigger number as the currency falls further and further. Remember that we are talking here about pricing in different currencies. It's not everybody around the world doesn't use US dollars for their own currency. I think a lot of people tend to forget that. And they're just thinking, well, this is the way it is. You have to understand what's their currency worth today. And then you have to know that there's a reserve currency, and this reserve currency is going to be pricing all of the commodities. So if Turkey wants to do business with another country, let's just say Russia, for example, they have to price it in US dollar. That means they have to buy US dollar, then they have to give that US dollar to Russia. But that would be a very big problem to a country that has seen a 40% decline against the dollar. Suddenly, things are 40% more expensive. That becomes unacceptable for a lot of businesses. They start to look for other partners. They start to do, close up shop in many cases. It's been a big problem, not just in Turkey. This has been going on everywhere. I'm not going to read the article to you. It's not exactly a happy one. This is talking about Argentina, talking about rations, talking about lineups for food, talking about struggling in a crisis. Consumer prices are soaring, unemployment is high, and the Argentine peso has plunged, bringing back haunting memories of the country's economic meltdown in 2001 that pushed millions into poverty. I truly worry for the people of Argentina right now. I know that some people have suggested it's not a problem, but this will not turn around on a dime. I assure you that. It's going to be a crisis that continues to get deeper and deeper. But of course, FANG stocks are up, so we don't need to worry about it, I guess. And last but not least, if you want the financial education you were not taught in schools, these two books have it all. You can check them out at the link in the description.